Hey, good evening, everyone. It is Tuesday evening. We had a pretty incredible day following a fairly incredible day yesterday. Yesterday was the DeepSeek correction crash that sent semiconductor stocks just to crash and burn. And today we had a bounce back, not quite covering all the losses that were obtained on Monday, but Tuesday was a pretty good recovery and it really sent stocks flying up. The NASDAQ for the year is up 2%. And that's not bad considering we had a pretty significant scare on Monday, which sent stocks down. And we'll take a look at the semiconductor space in a bit. But overall, you could see the volatility, right? You've got these really down moments. Earlier just this year, we were down 4%. And then, of course, on Monday, we had a pretty severe pullback combined with, I guess, the sell off we had on Friday, 3.55. I wouldn't be surprised if we're in this type of volatility for 2025, especially here at the beginning of the year. We have something to worry about. We have high stock prices. And if any bit of bad news enters the picture, these stocks are selling off. It's scary for investors. And especially investors that are sitting on stocks like NVIDIA or Vistra or Super Microcomputer. These stocks are so touchy. If they get some bad news, sell off because they're just so expensive. And I don't think it's going to end well for the stocks that have those valuations because everything's priced to perfection. But the reality is it's very hard to be perfect for a long period of time. As time passes, I think more stories will come up of how the AI space is so new that there will be continued advancements and innovations. Just like DeepSeek came into the picture and said, hey, we did it faster, cheaper. And people are questioning, oh, well, maybe it's a lie. Maybe it is, maybe it's not. But I bet you other companies are going to come out with similar stories where they have come out with a better mousetrap, a better way of building AI at a lower cost. So I think that's going to continue to happen. And I expect that a lot. San Diego, what's up, man? How are we feeling about Microsoft and Apple? Those are two really key stocks this week, and I'd love to talk about those. I'm going to note them, and I will cover them. Just hang tight, and I will provide comments. What I'll do, guys, is I'm going to have some opening comments. And there was one stock I wanted to look at, which was Chubb. It announced after hours. We can go through the earnings, do the complete evaluation of the stock, and I'll give you my opinion. And then we'll get to the list of stocks that you want to look at. And that way I could queue up a good number of stocks and then kind of hit them kind of in one string. So bear with me. Thanks for joining. I appreciate it. Sounds like you're from San Diego, and I'm here in California as well. So good to have you. All right. So we're talking about the NASDAQ. What's the S&P doing year to date? Well, year to date, it's up 3.16, and that's good. That's a good start to the year. Last year it did really well. Well, it's off to a good start. The Dow is really off to a nice start. And the Dow lagged the S&P and the NASDAQ by a pretty good margin in 24 and 23. So it's kind of coming back here early in 2025. And the small caps represented by the Russell, it's doing okay. Small caps, it's such a, pretty broad spectrum of stocks, a lot of bad ones in there. There are some really good performing Russell 2000 stocks. I have a couple of them. They're doing great. Especially software companies have really been noticed now. Software companies are beginning to rally, especially small caps. I'm going to go over DocuSign a little later, and I'm going to go over Zoom, which really had a good day. And I think investors are waking up to the fact that Zoom is a really high quality stock that is undervalued. And now it's receiving a lot of buys. So the stock really rallied today. We'll take a look at that. All right. So the Russell, Now let's take a look at the heat map. But before I jump over there, of course, I got to look at NVIDIA because that is the stock. This is like my soap opera, man. What is going to happen next? And again, just to remind everybody, from June to now, this stock's pretty much going sideways. If you buy it in June, you're sitting there going, why do I subject myself to this kind of risk, this kind of stress, this kind of worrying to go sideways? I could have bought Meta and been up 40% from that point. I could have bought a lot of stocks. Like I could have bought Robinhood and been up 100% from that point. I could have bought SoFi and been up 100% from that point. There's just so many stocks that have outperformed NVIDIA. Meanwhile, this stock continues to be over $1 trillion in market cap. It lost about $600 billion of market cap yesterday. Huge decrement of capital leaving NVIDIA. A lot of it flowed back, but yesterday it started the day at 3.5 trillion. It made it back to 3.16 trillion, which means that 0.34 trillion didn't make it back. So in my book, the 2-day, this stock's severely in correction. And the volatility, yeah, we had to come back today, but what's going to happen tomorrow? Be really interesting to watch. Of course, I'll be watching and checking it out. All right, so looks like, say, Diego, you want to look at Tesla, 120%. All right, we'll take a look at Tesla as well. I'll put that on the list. All right, so NVIDIA is just such a important stock nowadays. It's really setting the table for so many other stocks. Looking at the heat map, of course, the semiconductor space made a stupendous comeback. NVIDIA, clawing its way back. Broadcom did not claw back as much. This stock was shellacked yesterday. I think it was down like 15%. It got 2.5% back. And some other stocks, didn't, launch a comeback. So just a couple of stocks, of course, the most popular one made it back. Now, software, there was a lot of money made in software today. Man, just really good names. I don't even know where to start here. CrowdStrike had a stupendous day, up 9%. Fortnite up 3%. Microsoft up 2.87%. Palo Alto, Palantir. I mean, these stocks really moved, and a lot of them are small caps, not bad, big major, caps that are hard to move. So that did great. Apple really has been having a pretty good week, frankly. And I think all the crazy news around, DeepSeek and how it's posing a major risk for the semiconductor space and AI, that is helping Apple. It is providing cover. We are not focused on how bad Apple has been performing for the last 2 years, having no growth, having no real good ideas, and they've kind of, ducked for cover. And a lot of investors, I think, went to Apple as a safety move. They got out of NVIDIA or some of those other crazy stocks like the utilities that were up, just crazy amounts, and they moved to Apple potentially. Microsoft posed a pretty good comeback. And if you look at Microsoft year to date, and we'll look at it more in detail because there was a request a little later, we'll get into it because it's doing quite well for the year. I've been buying into Microsoft. I really want to own a lot of shares of Microsoft. Financials had a great day yesterday, not so much today, but it isn't this high, this brilliant red. When it's brilliant red, that's bad news. When it's this dull kind of burgundy or close to black here, it's just pretty much not too bad of a pullback. Asset managers did well. Amazon came back. Of course, Amazon's awesome. And we had some travel stocks do really well because one of the cruise ship lines had a fabulous earnings and they went up like 12%. The two bigs in communication services, Meta and Google, did quite well. And a little later, I'm going to show you year to date on Meta. They are doing great. I am so glad that I own Meta. It's the biggest position in my portfolio. It really held my portfolio, with little losses yesterday. I was down 0.27 yesterday. I was up about 0.89 today percent. So for the 2 day, I'll take it because I'm sure some other portfolios just got really beat up because a lot of stocks were down big yesterday. Industrials, nothing to talk about there. RTX had a very good earnings, but I would say that, LMT is one of my holdings, and I bought more shares because I think this is a little overdone, down 9%. I still think these guys are going to bounce back because they had a temporary cost element that reduced their free cash flow. And I think that lowered their valuation, but I think they're going to come back in 2025. So this was a mixed bag here. Some stocks did well, like Raytheon did really well, but some stocks did not. Like LMT did terrible. Healthcare took a break today. It was up yesterday, and today not so much. But yesterday had a very good day. So over the 2 day, it's doing just fine. Pfizer had a very good 2 day run. CVS is still in the green. CVS is doing really well. So CVS has been really working here in 2025. I think it's up to 25-30%. So that looks really good. Hey, it looks like Mike's on. REITs did great today. Then today, REITs did great yesterday, and then they died today. Oh, no, that's not good. Vici, I like Vici. I like what they do. And then O is Realty Income, I believe. And then Rex R, I'm not sure what that one is, but we'll take a peek at those, Mike. Give me a few minutes. I wanted to have just a stream of thought here, but I'll get to those stocks. Sorry to hear that REITs went down. So healthcare, I think, is going to present a pretty good proposition for me in 2025. I'm buying into CVS. I'm buying into Elevance. I bought some shares of Pfizer. I couldn't resist. I think Pfizer is going to surprise to the upside on their earnings, and I wanted to have a couple more shares. Energy had a bad day, but they've been having a decent year and a pretty decent couple months. Utilities, these guys had a very good day, but yesterday, independent power producers up 6%, but yesterday some stocks were down as much as 28%. So hey, it's nice that you're having a recovery day, but yesterday you got shellacked. You lost so much money. So that's that. So that's what's going on out there. And I think Mike was interested in REITs. Yeah, REITs was a little red out there. Looks like specialty REITs got beat up. Office REITs, boy, they've had a terrible couple years. Looks like services, real estate services was probably the place he wanted to be, or industrials, right? That makes a lot of sense. So that's what happened in REITs. I think the flight to safety wasn't the move today because yesterday, consumer staples, this was bright green. Everybody's going flight to safety. Today, you know what? Let's pull some money out of Procter & Gamble and put it into some of these growing stocks. Let's pull some money out of Pepsi and put it into some of these growing stocks. So I think that's what was going on today. And we'll see what happens. These days where you have one severe down day and then a recovery day, this is typical of a correcting market. If you remember 2022, this is what we dealt with. If we look back at 2022, let's get in the time machine together, shall we? And let's go to the 5-year, which won't show me, a whole lot, but we would have these down days and then we'd have up days to give us a little bit of hope, down, and then a bear rally, down. So if we have these severe down, trends, we're going to get into a nice correcting market. It's too early to tell, but I'm just saying it's normal for the day after a massive correction like the one we had yesterday, where in one day NVIDIA lost 17% and so much capital left a particular sector, that capital isn't going to go back. And it's going to kind of reestablish a couple of things: is which sectors are desirable and where's the money going to flow? Where's the smart money going to flow? The other thing I would say is, as the S&P index, and I think it rebalances at the end of each month, or I'm not quite sure. I wonder how often it rebalances, every quarter, every month. I'm not sure. But if you have certain stocks that basically lost a lot of value, it gets worse because when the S&P indexes rebalance, all the ETFs that are based on the S&P, they have to sell off a certain amount of stock so it could correspond to its appropriate share of the S&P. So that's what's going on overall. A couple more things to show, and then we're going to get into some stocks. So the sector that had the most appreciation today, technology, no big surprise, but yesterday it was down big. Consumer services, Meta, showing up big. Nicely done. Okay, so those are the winners, but year to date, let's look at the scoreboard year to date. We got, I don't think that's, here we go. So the leader of the pack, the leading sector now is communication services. Beautiful. I am invested. That's probably in the two stocks that I own, the most shares in, or the most value, I should say, is Meta and Google. And those are consumer services. 7.4%. I'll take it. And Netflix is in there. They're having a great year. So you can totally understand that's a sector that's doing really well. Healthcare, beautiful. I think this historically has done really well. For it to only do 12% in the trailing 12 months, that means that, and when you look at these stocks, they're undervalued, low PEs, high cash flow, growth. You're seeing all the right elements, all the right fundamentals that I want to see in a stock. You find a lot of good looking stocks in healthcare. Financials have been doing really well. 2025 was a stupendous year, and they're having a good start to 2025. Materials showing up well, industrials, everything else is out there. It's in the green. Technology still lagging the rest of the market, even though it had a nice day. For the month, it's down almost 1%. So that is interesting to look. Now let's look at the big, massive caps, the Magnificent Seven, the top 10. They've been so important to the market for a while. Let's take a look. Apple's had a couple good days, but it was in correction territory. It was down 12, 13% at one point. It's still negative for the year. Microsoft bounced back. It's doing well for the year, 6%. I'm buying into Microsoft because I think it's undervalued. We're going to get into Microsoft. I'm going to go step by step, look at it closely. It was requested by somebody, so I'm going to dive into it. NVIDIA, it's down 4% for the year. It was up 9% today, but it was down 17% yesterday. Amazon's doing good. Amazon's doing very good for the year. Google's just holding it together compared to the others. But look at this. Meta up 16% in 2025. Meta did not get hammered yesterday because the story around that was Meta can basically, they don't have to pick the right horse early. They can switch. If the whole DeepSeek story is true and they've come out with less expensive AI, Meta could use it. They can put it on WhatsApp. They could use it across more of their applications and it'd actually be less expensive to use. So that was the story behind that. And that's why Apple also rallied, because Apple doesn't have a big AI application or a large language model. And they could switch to these less expensive AI models if they, in fact, are less expensive. Let me remind you of something. TikTok put social media on its back when it came out. It was so popular. Now the Chinese have come out with an AI application model technology that is really impressive. So let's not take away, or I should say, looking at it from a impartial position of, hey, are these guys capable over in China of developing technology? You bet. They did it with TikTok. They've done it. TSM is a Taiwanese company. You have a lot of companies in China that are really advanced in the ability to create really solid technology, software. In the case of TikTok, I mean, they nailed that. Short form video. It was such a high growth company, so high growth that the government in the US has to ban it because it's so popular. It just grows across so many people. And I have friends that are my age that love TikTok. They just love the experience. Well, that's Chinese. That's a Chinese technology. Now they're coming out with AI. Hey, man, they're probably going to be a force to be reckoned with. It's going to be the US versus China for a long time. I don't think I'm breaking any news with that comment. Tesla is still down for the year. It was just barely hanging on today. Berkshire, not a lot of noise out of Berkshire, but they're still $1 trillion market cap company. And I'm sure they're holding their own because they own so much darn Apple. And then Broadcom came back, but they're in correction territory. And I think Broadcom is severely overpriced. All right, so that's what's going on with the major caps. Today we had earnings from a number of companies, and I'm gonna start with Chubb, excuse me. And Chubb announced, I haven't looked at the earnings. I thought we could do that whole process together, and I'll go through my process with you. And out of the ones that announced today, Starbucks looks a little interesting. We can look at Starbucks if you guys request it. I'll let you guys decide it. I've already looked at Lockheed. I released a video this morning. If you want my opinion on it or my comments on it, you can look at my videos. It's a short form video if you want to see that. So if there's anything that announced today, put it in the comments and I can look at it. But I am going to start with Chubb right after I check the comments. Let's take a peek here. Looks like Michael Anthony's on. Thanks for joining. And Michael Anthony, you buy more CVS, rather buy more PFE? Yeah, I'm buying both. And, two different businesses. I think Pfizer, I mean, something inside of me, or really my analysis tells me they're going to bounce back in a big way. And we'll see. We'll see if I'm right or if I'm wrong and if the market likes or dislikes Pfizer. But that's what I'm doing. We'll take a peek at Pfizer and we'll take a peek at CVS. Put those on the list. Okay, which REIT is best? I'm not a big REIT guy, but I own CTRE. I'm happy with it, but I'm not a big REIT guy. I would rather disqualify myself in that space. And Mike owns CVS and Pfizer. I love that dividend from Pfizer. CVS, I think it's already rallying really well. So I think other people are waking up to the fact that if that thing gets back to what it historically is done, it's going to be worth 2 to 3 times its current value. And I know that's a pretty big statement, or I should say that's a pretty optimistic point of view, but just study the stock, study the fundamentals. Maybe you'll get to the same conclusion as I do, because that's the conclusion I get to. All right, so T was great. AT&T did announce really good earnings, and we can go over that. I'm not into T, and I'll tell you why when we cover it. And then Carlos, Starbucks. You want to talk a little Starbucks? Good to see you, Carlos. We can definitely talk about Starbucks, and we can talk about Meta. Man, Meta is got it together. Just a lot of things are happening for the company, and the stock is really going up. There's a lot of reasons why. Fundamentally, it's a solid stock. Mike, dividend investor guy. Okay, so you got a question from Mike there. All right, cool. You're up 19% on CVS. Awesome. Nice. Very nice. Okay, so let me get into Chubb. And I'm going to give you a quick tour of Chubb, and then I'm going to open up my valuation and kind of update all the analysis. So Chubb is a fairly big market cap. Its market cap is 109 billion, revenue of 54 billion. This is an insurance company, and it's an insurance company with a variety of products in a variety of countries. Its PE is a very low 12. Isn't that awesome looking PE? We're in the land of PEs are 30 to 60 in technology, and these guys are at 12. Very nice. Analysts believe it's a buy, and it's discounted by 6.5%. They pay a small dividend of 1.34%. They announced today, so we're going to look at their earnings in a bit. All right, so looking at that, over the past year, this stock is up 12%, close to 13 with that dividend. Let's call it 14%. Not bad at all. And it's up 81% over the 5-year. Not bad at all. You add the dividend, maybe you're close to high 80s, like 88, 89. Of course, Warren Buffett owns Chubb. As soon as Warren Buffett owns a stock, right, it gains a lot of credibility. It certainly does in my mind. All right, so Chubb announced. Let's go straight to the earnings announcement and see what they said. So it's CB, Investor Relations. Let's hear it from the horse's mouth and see what earnings were issued out. And then I can update my valuation on the fly. You could see my process here. Fourth quarter 2024 press release. Let's take a look. Make this a little bigger so your guys can see it. All right. So, news release. Chubb reports fourth quarter per share net income and core operating income of $6.33 and $6.02 respectively. That's GAAP, non-GAAP. All right. And I'm going to kind of speed read, try to get to the meat of the announcement. Okay. So they're going to announce the quarter and they're going to announce the year. And I'm going to try to get to an earnings, like the financials. Written word is good, but for some reason, my brain works better with schedules and numbers. So let's get to the schedules and numbers. All right. So this is looking at net income. Okay, that's fine. And net income it went down from 23 to 24. Okay. I want to look at revenue. I want to look at the full income statement. That gives me the complete picture. That's why I want to look at it. Okay, so net premiums written, it went up 4%. Okay. So overall consolidated, the premiums went up by 4%. Revenue went up by 4%. They did announce that they have calculated how much they're going to have to pay for the fires in California. And did I look at the quarterly here? Maybe. Let's take a look. So that's Q4. So they grew 4% Q4, but for the full year, it's even better. They grew by 8.7%. I like looking at top line revenue because it tells me if it's a healthy business. A healthy business is growing the number of customers they have. They're growing the products they sell. They're raising prices. They're doing it like Netflix as an example. They keep growing subscribers. They keep raising their fees. That combination is excellent. And they keep growing their top line revenue. Top line revenue, there's no substitute for it. That tells me a lot about the business. Profitability is good, but when you look at a P&L of a company, you see where there's a lot of, massaging of numbers. They can, reserve certain numbers. They can bring back certain expenses and so forth. So it's a little bit of an artificial number to look at net income. It's still a good number. Free cash flow is also a very solid number. It's very hard to manipulate free cash flow. You either had free cash flow or you didn't. All right. So these are very important metrics, but for the sake of this live stream, I am going to get to the meat of what I need out of my valuation. I'm going to come back and read this in its entire length and a little bit later. All right. So we got that. And are they going to give me a statement of cash flows? Let's see here. Will a statement of cash flows be provided? Okay, now we're getting somewhere. So here's the balance sheet. And these guys will carry a balance sheet. They got investments. That's what they do with the money when they get all these premiums. They get to earn some interest on those. Higher interest rates is not bad for an insurer. Liabilities, unpaid losses. These guys hire really smart mathematicians. These mathematicians, they calculate how much their liability is going to be. All right, that looks okay. All right, so we had good revenue. They were profitable. And net income did grow on a annual basis. In the quarter, it came down, but on an annual basis, it did expand. That's good to see. So their revenue expanded and their profitability, the revenue and profitability expanded. All right, good. So we got that going. I'm going to open up another screen that you guys can't see so I can see some data, and then I'm going to update my valuation. That way you guys could see my valuation, and we'll go from there. So free cash flow for the trailing 12 months is a very good number, and So this is Chubb, and I value companies based on free cash flow and earnings per share, putting more weight on free cash flow because that is, I think, the best valuation of a company is how much cash can they produce. Now, this number is not going to change for me. I don't have a statement of cash flows, and the trailing 12 months that I have is actually it's a little higher than that. So this guy here, they're growing the revenue by more than 7%, which is good. I'm going to scale this back a little bit to 0.07, and I'm going to take trailing 12 months. So trailing 12 months is $15,169 billion. I'm going to multiply that times 1.07, which I'll add 7%. And then each year I'm going to add 7%. This is my forecast of cash. They really crank up the cash. That's why Warren Buffett loves insurance companies. He's a big investor in Geico. I believe they own the whole company. And now he's an investor in Chubb. For all I know, he's going to buy the whole company. He certainly has the cash to do so. He can buy it with one check. I'm sure he wouldn't pay with a check. He'd pay with some kind of escrow account. But you see that all this cash they're generating becomes this massive value, $326 billion of value. Adding cash and take away debt, we get to a massive equity. So this, just based on cash flows, severely discounted, 184%. Now, looking at earnings per share, when I look at that forecast, analysts think it's a buy and it's discounted by 5.5%. Now they're really giving them a low PE, which is incredible, right? These guys are going to do about $9.80. Am I reading that right? Am I looking at the right currency? Yeah, US dollars. Looks good. So earnings per share is $9.80. PE of 18. So forward PE. Analysts have some really low PEs on the stock, which I don't agree with. The earnings per share is expected to grow 17% for the current year. So I'm going to grow that by 10%. So I have a very discounted stock, in my opinion. It's a very good company. It has good pedigree. They produce just wildly high cash flow. And this is a stock that we went over on pretty much a live stream. It came up, I looked at it, and I'm like, man, that's a lot of cash flow. I'm already an Allstate stockholder, and I'm happy with Allstate. And insurance companies have been doing really well. So hey, you know what? There's no rule against me not owning two insurance companies, and I'm buying into Chubb. I bought shares today, and will continue to buy shares in Chubb. I think it's a really, really good company, and I think it's undervalued. I think this guy is going to deliver on with appreciation. And if we look at Chubb, one thing I look at is, okay, let's compare it to some of its peers. And Allstate's one of its peers that I'm very familiar with. So is Progressive as insurance, and Progressive's had a phenomenal year. And a couple of things that I would show is year to date, looks like Progressive's still number one. They're really kicking butt. Their stock continues to go up, but their valuation's a little tight. It's got a high PE and they don't produce a lot of cash. But when we go to the 1 year, still Progressive is number one, Allstate's number two, Chubb is number three. And I think that Chubb could have a bounce back year and really appreciate toward where its peers are at. That's one of the things that I think may happen. Of course, investing is both art and science. The arithmetic, that's all science. Looking at metrics, you can say that's science. But the art is really using one's imagination that's rational. And my imagination is that, hey, this Chubb company is a good company. Insurance has been outperforming. I think Chubb's going to outperform because it is going to revert back to the median within its peer group. And right now, Progressive, I think, is priced a little high. My hat's off to progressive stockholders, but I think the money's going to be made on Chubb. That's my opinion there. All right. So we just got through a valuation there on Chubb. I thought their earnings were decent. I'll go back and study them more closely later. All right. So Mike, the dividend investor guy, you wanted to talk a little Vici as well as some others. We'll fly by Vici real quick. And Vici is a real estate investment trust focused on casinos. It was down 1.77 for the year to date. It's doing 2.74, pays a nice dividend. Hey, that's still pretty good. That's pretty good. 2.74, and then you get that nice dividend. I think they're doing okay. For the 1 year, not okay. It's down 1%. That dividend's okay, but underperformed the market. So I think these high interest rates really scare the investor. And I mean, they were trading at $34 a share. Now they're down to 30. So the money was lost, or I should say it depreciated from September to this point. So Vici is a quality company. Every time I look at it, it's really well run. They focus on casino properties, a lot of them in Las Vegas, but they also own other properties around the country. I really like Vici. They're good stock. I don't own a lot of REITs on purpose. If you're looking for a good REIT, Vici is a good thing to consider. The other one you want to look at is, I think, Realty Income. Realty Income, what makes them a little different is they pay a monthly dividend. So people that like income, they really like Realty Income. 5.7% dividend. The thing about REITs is, one of the things I don't like is I would rather have appreciation versus dividends. It's just, I'd rather have 100% rate of return over 5 years or close to it versus I lost 26%. Yeah, I had a dividend, but it's really hard to figure out, did I break even? Well, heck, I don't want to own stocks and break even. If I want income, I'll own bonds. And the heck with this stock market, volatility. So that's, I think, Mike, you've heard that. You've heard that from me. That's my mindset. But some people own REITs. They're really important. So I get it. So that's Realty Income. Had a bad day. What are they doing year to date? Doing pretty decent. Up 3%, paying that nice dividend. That isn't too bad. And then it was Rexford Industrial. So this piece should have done okay. Yeah, they were only down 0.58. And it looks like for the year, they're having a nice year, 6.5%, paying a 4% dividend. But for the year, man, that's a pretty good haircut. And again, the 5-year, man, I do not like that. I want appreciation. I want my stock to be worth more. I want it to grow my wealth. I want my stocks to work at night while I'm asleep. When I'm nice, comfortable under a nice warm blanket, my stocks are creating value for me. And the value I like the most is when a stock doubles. And it doubles, once every 5 years. That is an A grade stock. If it goes down in value like this, that's not good. That's not good for me. So that's the lane that I've picked. So let's hope that REITs come back. I know interest rates went up a little bit today, and I think that's what's driving the real estate investment trust market. And yesterday, interest rates went down. So that's what's going on there. All right. So getting back to the list of stocks that have been requested. And if you showed up recently, please bear with me. I'm on a list of stocks that people were asking for. And the next one that is up is, I think, requested by San Diego. How do I feel about Microsoft? So I think I already kind of telegraphed some of the comments that you're probably going to hear is I feel really good about Microsoft. It's a really powerful company, and they have a diversified technology business. For the year to date, they're doing 6%. They pay a tiny dividend. And again, I don't care about dividends, but 6% is pretty decent. What caught my attention is over the last year, this stock didn't go up like Meta or Google or, their rivals. Even Apple did better. And I look at that, I'm like, okay, well, maybe their revenue isn't growing all that much. Well, no, revenue is growing great. And they're a big, giant company. They're growing at 16%. Well, that's stupendous. You look at Apple, they can't even grow 2%. So how is it that Microsoft's not appreciating when they're showing this kind of growth, they do have a very solid position within the AI space. Now, that position may have lost a little value now with DeepSeek in the picture. And if DeepSeek is the real deal, it's going to take a lot of value from that open AI business. So even with that, Microsoft has a fabulous cloud business. They have a fabulous software business. And it's rumored that they're going to acquire TikTok. So if they make TikTok function and be profitable in the US, look out. They're really good at acquiring companies. They acquired Activision a couple of years ago. I was an Activision stockholder. They bought my shares. Thank you very much. They paid cash, and I walked away with a really nice gain. So I really like their revenue growth, and I really like their free cash flow generation and their profits. When we look at free cash flow, I mean, look at this here. $72 billion of cash flow in the trailing 12 months. 72 billion. Most companies don't have that in revenue. These guys generate it in cash. Wow, incredible. And when we look at their gross margins, 70% gross margins or 69. That's very good because they're a diversified business. Not only do they do software, they do some hardware products like the Xbox, and they do a bunch of peripherals. They have their cloud business, which they buy infrastructure, and then their hyperscaler, and that business is doing great. They're invested in OpenAI, which isn't quite profitable yet. So a lot of good things happening for Microsoft, and to me, it's a pretty big surprise that the market is looking at this stock going, I don't know if I want to own Microsoft. Over the 5 years, it's been a really good winner, 175%, no doubt. In 23, they just crushed it because they had that big investment in OpenAI. But in 24, not so much. They really started the year really nicely, and then the stock didn't do anything. Well, guess what? I'm going to buy some shares because I think this stock is going to double for me in the next 5 years. I think Microsoft's going to do well. Now, when we look at what 30 analysts cover it, they think it's discounted by 14.5%. I agree with them. I don't have a heavy discount on Microsoft, but it's just such a good business that there's only one Microsoft, and I want to be a stockholder. These guys are going to keep growing their earnings per share. Real nice growth, 15%, 26. They're already in a fiscal year 2026. I should say they're in fiscal year 2025, which ends on June 30th, and they're going to grow it this year, 12.5%, 15 the next year, 18. I mean, that's beautiful growth. Look at their revenue. It's expected to continue to grow. All those things look awesome. They look awesome. So my feeling on Microsoft is, hey, I'm going to keep buying shares, man. The market's going to give me a really a desirable business like Microsoft at a discount. Even though the discount isn't all that great, I will buy it. I will gladly pay a fair price for a great company. In this case here, I calculate that they're discounted by 7%. Not a big discount, but I'm buying shares hand over fist. Today, I bought some shares. Yesterday, I bought a lot of shares, and I'm really glad I bought a lot of shares yesterday. So I'm glad to buy a lot of Microsoft. It's probably the most accelerated buying that I'm doing on one stock. I dollar cost average, but this one here, I just kind of dollar cost average at a fast pace because it is Microsoft. And I feel like I think this is going to catch on. Of course, they're going to announce this week. And once they announce, the stock's going to move. And we'll see if they give us some new information. One thing that's happening is this whole DeepSeek news has really changed the mindset of the investing community. And I think that it could change the dynamics that we've experiencing for the last 2 years. Literally, CEOs could have said anything, just wild imagination ideas of AI. Oh, it's going to do this. Oh, we're going to spend this amount. Oh, yeah, we're going to do all these crazy things. They're going to cost money. But now the DeepSeek saying, yeah, we built AI on a shoestring budget. I don't think it's going to be acceptable for a company to come out and say, like Microsoft said, we have $80 billion we plan to spend on AI infrastructure. Well, maybe they're going to have to pump the brakes on that. I don't think it's going to go over really well. Hey, we're going to overspend a bunch of money on AI and just burn a lot of our cash. maybe you should pump the brakes. Maybe you should study what the heck these DeepSeek guys are doing. And if it is true, maybe you can copy them. Hey, there's no rule against, copying success. It's, a compliment. It's a compliment if you copy somebody's great work legally. Of course, you're not stealing any patents. But if they have a method of, hey, instead of using a really expensive cluster of expensive GPUs, they use a different technique, maybe a better way of doing it, people are going to copy it. If they do that, it's going to be less expensive. Microsoft does have the ability to market and sell their AI apps because they're a software business. So all that sets up really well. There's just a lot of permutations that favor Microsoft in the future, which is why I want to be a stockholder. And that is my story on Microsoft, Mr. San Diego. And you had a question on Apple. You hope Apple drops the bag. Um, you know, I think I've doubted Apple for a while, and the market has really done what the market's going to do, which is they're not going to listen to me. They're going to do whatever they want to do. But I look at their growth and I'm like, how does this company continue to go up in value with no growth? How? I just showed you Microsoft was at 16. These guys are at 2. And Microsoft cannot catch a long-term appreciation trend. These guys have appreciated close to 24%. That's with a more than 12% correction in the last 30 days. They pay a tiny little dividend. Their forward P is 32, but this one here could be just dead money for 2025. That's my observation. I do things on fundamentals like revenue growth and cash flow and so forth. But the market may still be a buyer of Apple because they view it as a safety stock. I mean, everybody knows who Apple is. So we'll see. We'll see what happens there. They'll announce. I mean, it's expected that they're going to announce and say, hey, we don't have any growth. But we have a new iPhone coming out, and it's going to have one more feature that we think people are going to like. But they don't have any new products. I mean, you got to tip your hat to companies that are continuing to grow. For example, Meta. Meta has a full-blown AI business now. They provide a large language model, open source. They named it Llama, and they provide it to developers. They also have a very good app that you can get to, meta.ai. It works really well, and it's free. It's free. It's better than OpenAI because OpenAI will charge you after a certain number of searches. And Gemini, same thing. Gemini will charge you money at some point, but Meta's completely free. So Meta's doing a lot of good things. And I could say that about Google, but I can't say it about Apple. They don't have any. What's the next great thing about Apple? There's nothing in the pipeline that is really exciting. Nothing. And I just laugh when I see their commercials because they're raving about, oh, AI is going to enable you to create your own little emoji. It's like, who cares? I guess emojis are cool, but is that really what you're trying to do, Apple? Changing the world by changing emojis? How about you develop something exciting like, an AI app that, helps you with your health or helps you with something as opposed to just emoji generation. So Apple, I'm just not an investor of Apple. In fact, I'm probably a short seller on Apple. So we cranked through Microsoft. We talked about Apple. All right. So let me catch up on comments. And I still have a list of stocks, guys. Bear with me. We went over Vici, Realty Income. We got Tesla to go, Pfizer, CVS, AT&T, Starbucks, and Meta. Those were requested. Let me make sure that I'm reading all the comments. All right. Da Boss. Should I buy some NVIDIA right now? I'm not buying NVIDIA. I actually have a short position on NVIDIA. So my answer is I would not buy any NVIDIA. You'll have to make your own decision on that. So Mike on Fast Money was looking at Vici and MFA, which I think bought MFA. Yeah, MFA looks interesting. We've covered it. I think we covered it. I think on Sunday or Thursday. And I think I have a video releasing on my channel. So Microsoft is getting a dip back to 400. Yeah, but it's after hours action, right? It's we'll see. We'll see. It's not nowhere near 400. We'll see. We'll see where it goes. Um, but if it gets to 400, I bet you'd be buying, huh? Yeah, MFA has a huge dividend, but those dividends are teasers. I'd rather have a stock that goes up 80% in 8 years or 5 years or 100% in 5 years. That's what I want. So happy Chinese New Year. Happy New Year. Savage Trades. Happy Chinese New Year. China has a surprise for the American stock market tomorrow. Well, we'll see. I know Alibaba had a decent day. Baba has had kind of a couple decent days. They had a decent day yesterday. They were up 6% yesterday. And you look at the year to date, 13%. I'll take it. I'm a Baba stockholder. This is the biggest cap stock out of China. I think it's a fabulous business, discounted. It's just located in China. That's why investors don't buy it as often as Amazon or its rivals. So I'll take it. I'll take 6.71%. I own a good number of shares, and we'll see what happens tomorrow. I think this time of year in China, don't they take like a lot of time off? They celebrate the new year, so they take a lot of time off. So I know that supply chains, they have to kind of work around that because they don't want to be caught in periods when they can't get materials or products because the Chinese are celebrating their new year and they had celebrations for a little while. What about HPE? I don't like HPE. I think it's a legacy hardware company that doesn't know how to get to the cloud. It's just its business, its heyday was 20 years ago, and now it's all cloud. And the big cloud players are the hyperscalers, AWS, Microsoft Azure, Google Cloud, and they needed to have built a cloud business 15 years ago. They're way late. They're not going to. I don't think they'll be able to build one. So I don't really invest in HPE. I think it's a short term. Maybe you have a short term gain, but in 5 years, I just have to guess that they're just not going to be worth much because they're a legacy company. All right, so China is going to close for a week. Yeah, that's what I thought. That's what I had heard. I think every year there's the Chinese New Year is celebrated. Well, hopefully they have a good time, and hopefully they keep their stocks moving. They keep Alibaba stock moving up, and I also own an ETF of Chinese stocks, so we'll see how that goes. Okay, let's get back to the list. Let's go back to the very popular Tesla. Tesla, it doesn't need fundamentals. It just needs a cool story coming out of Elon Musk, and then it'll crank up. It doesn't matter that they don't create cash flow. It doesn't matter that car sales are in the negative. Look at this growth. No growth. It doesn't matter. This is Tesla. They defy gravity. It's just their car sales are declining, and they're a car company. I know some people believe, oh, it's a technology company. Yeah, that's fine. But when you look at this revenue, those are automobile sales, and they have a very good car, very innovative. Got it. But you look at their growth, there is no growth. And you look at their other fundamentals like free cash flow, 3.6 billion. That's not a lot, not for $1 trillion company. I showed you Microsoft had 72 billion. These guys have 3.6 billion. That's nothing. That's nothing for $1 trillion valuation company. 18% market gross margin. I just showed you Microsoft was at 69%. You see the difference in fundamentals? Just very, very different. This is a less desirable business. And the people that say, no, they're a technology business. Well, you can keep saying that, but their fundamentals say they're a car company. And that's the fact. Look at their margins. Look at their free cash flow. It just doesn't add up. It's not a technology company. Google is up there, 60-70% margins. They produce cash flow up in the $60-70 billion range. Those companies deserve to have those valuations because they crank out cash flow. We invest in stocks to make money. When companies produce money in the form of free cash flow, they return it to stockholders in the form of buybacks, dividends, or they hoard it on their balance sheet. They acquire other businesses for cash. They make their enterprise bigger. All those things are signals of a valuable, desirable business. This is not a desirable business. They are raising capital by being super popular, in my opinion. How are they going to change this free cash flow? I don't know, because you have such a low margin business. So I am not a Tesla bull. I'm not a Tesla buyer. It's also a difficult stock to short because they have a rock star CEO. He says, man, something cool and boom. And then more recently, of course, his close relationship with Donald Trump has really made him uh, a very influential person. So people believe that's going to be a way of him adding value to Tesla. That's probably correct. That's probably a story that holds water. Now, not saying this is happening, not saying this is going to happen, but in the first term, I think people did not last the 4 years with Donald Trump. I don't know that anybody lasted 4 years with Donald Trump. I think it was uh, the Mooch. Uh, he was there for like 2 weeks and then he bounced and he was out. Just about every key ally to Trump at the beginning ended up leaving like within a year. So if it ends poorly, or if it just ends, period. If let's say Elon Musk is like on the outside looking in from in the Donald Trump sphere of influence or circle of trust, this stock's gonna collapse because investors are like, oh well, if you're not gonna have that kind of influence, we're not going to expect a big bump. We're not going to expect you're going to get a bunch of revenue as a result. We'll see. This certainly is a soap opera stock, and we'll see how it performs. So that's Tesla. So let's talk a little Pfizer. And Pfizer is going to announce on February 4th, which is next week. And I think they're going to do well. And the thing that I'm expecting is for the year, not doing so well. For the 5 year, not doing well at all. And a large part of it is there was a run up on the stock, and then it collapsed. Now, big dividend. And when we look at their financials, trailing 12 months, there's negative, but that's because they had to stop being compared to years where they had COVID vaccines. Now, when you get away from that year and you look at the quarterly, they're growing by 31% because they took a lot of the money that they made during the COVID years and they acquired businesses that are now producing more revenue. And when we look at their annual revenue, another thing that I like to look at is how were they in 2019? Because this was pre-COVID. This was kind of a more normal year. They were a $41 billion company, but today they're $59 billion. They're 50% bigger, and they're making more cash flow, and they're making more profits, and they're that much bigger. But when you look at their stock price, the stock price for the 5 year, their stock price is lower than it was in 2019. I guess the beginning of 2020. So you're getting a bigger company making more money, making more profit, making more cash flow for a discount compared to their 2019 valuation. To me, that's a really good opportunity, especially if they come up on February 4th and announce a 30% revenue gain or even 25 or just up their high 20s. To me, it's like, okay, this business is healed and is going to start really wowing the market when it starts growing 20, 30%, because they're a big company. So that's what I think could happen. I think has a pretty good likelihood of happening. I'm really watching because I think it's going to happen. And if it does, I think the stock's going to rally. So Pfizer looks really good. I think the stock, and I try to, be as conservative as I can. but I think the stock is discounted by 54%, just because the business is really solid and their earnings per share. I'm using their guidance numbers, which they should exceed because usually management will provide a low number or a number that they can beat. That way they can beat it and raise it. So I really like Pfizer. I think it's a good stock. And man, February 4th, this is going to be a biggie for me. Speaking of big earnings, tomorrow is a big day. Man, get a good night's sleep. Well, actually, we don't need to get a good night's sleep. You can sleep in because after the close is when the big guns are going to come out. Microsoft, Meta, Tesla. You better believe I'm a live stream tomorrow. Same time, 5 p.m. Pacific, 8 p.m. Eastern. We're going to talk about Microsoft. We're going to look at their earnings. We're going to look at Meta, see what's going on. We're going to look at Tesla, see what kind of stories Mr. Elon Musk is going to tell. And we'll look at ASML because that's a really important stock. That's going to come out in the morning. So we'll see how the market treats the earnings. This one has had kind of a roller coaster ride, even before all this excitement of DeepSeek. ASML announced like a quarter ago, and they had a good earnings for that quarter, but they said, hey, our guidance, we're not quite sure what's going to happen. It's semiconductor companies are not putting in a lot of orders for these big machines they sell, and their stock got hammered. ServiceNow is going to announce after the close tomorrow, as well as, I mean, it's a big day. Lam Research is going to announce after the close. I own Lam's Research, so I'm going to take a look at that one. So it's a big day, and then followed by another big day. Apple being the biggest stock in the after hours, but other big companies like Caterpillar is going to announce, Comcast, United Parcel Service. So we got some big earnings in store. All right, so I talked about Pfizer. I think we wanted to talk about CVS. CVS is getting it done in 2025. This may be one of those stocks that's doing well because it's done so poorly in the past. When you look at this stock year to date, it is up 27%. Beautiful. But that's because the stock has been just shellacked for the last 5 years. And it's gotten to such a low point that, man, it's kind of left for dead. But I have made it a habit to find stocks that look like this because they have good fundamentals. They rise because the market can't keep a quality business down forever. They have a low PE of 10. Buy rating by analysts. I think they're discounted as well. When you look at them, they're growing. They've been growing through that whole downturn. It's like, what does a business have to do to get some credibility in the market from these investors? I mean, they were just on the trail of AI, I guess, and they're like, CVS is terrible. And but healthcare, I think, is going to bounce back. I think it's going to do well. Gross margins, it's a retailer, so they're low gross margins, but they have a massive revenue number. So overall, I think CVS is a good stock for me, and I'm going to keep buying shares. Even on up days, I'm buying shares because I think these guys are going to make it happen. They're going to announce on February 12th, so that's like 2 weeks away, and we'll see what they say. Man, they are having a good year. It's good to see that. These guys were a solid company, a solid stock 5 years ago. And maybe they can get back there and they can pay that nice dividend, 4.64%. That's a solid dividend. I'm sure that CVS stockholders are like, hey, I'm happy with the performance in January. Appreciation at 27%. I'm set myself up to receive a nice dividend. So I get both income and appreciation. Thank you very much. I will take it. Go CVS. And what is my value on CVS? I don't know if I showed that yet. So let me show it real quick because that one is easy to show. So here's CVS. I have a 67% discount on it. I just think that their free cash flow and earnings per share just have a greater value than the current stock price. I even discount it at a 9% rate, which is a little higher because, hey, this is a retail business. So I want a greater rate of return because they could be exposed to some undesirable risk. So this guy here, I mean, we'll see. I think healthcare is going to be a winner for 2025. CVS so far is really owning up to that brand, and hopefully they have a good earnings in 2 weeks. And between now and then, if the stock keeps doing what it's doing, I will be happy to see CVS continue to rise in value. It's been interesting to see that during a time when stocks that have been red hot for 2 years and semiconductor are seeing capital leave their stocks. It's ending up in these little companies. Now this is a little company of 72 billion, and it's easy to buy these stocks because I mean it's down so much. How much lower can it go, right? And this thing's trading for its 5 year below its 5 year low or previous low in 2020, even during COVID. It was trading lower, which made it such a good opportunity, in my opinion. That's why I was buying shares, and I continue to buy shares. Even on up days, it was up today, I bought shares, and I'll probably buy shares tomorrow. This is another stock that I'm accelerating my buying: Microsoft, CVS, and Elevance. I'm accelerating my buying just so I can build good positions, and we'll see how it does. All right, so that's CVS. Forgot who asked that on the live stream, but thank you for asking. Let's talk a little Starbucks. What's going on with the new CEO? We have a new CEO at Starbucks. He came over from Chipotle, and he announced his earnings, and it's up 0.38%. Over the 1 year, when they announced and they hired their CEO, I was a Starbucks stockholder. I bought the stock on one of these dips, and I took the money and ran. I took the money, cashed it, bought myself a nice dinner, and collected that money. And since then, the stock hasn't done much. And it actually had a nice pullback recently. But I'm going to wait and see. I think the Starbucks business is a good business, but it's $114 billion market cap. It is a retail business. It's a restaurant. I like the type of restaurant it is, but a PE of 30, I mean, it's a restaurant. I'm going to pay a PE of 30 for a high-tech company or a biotech company that has a new drug that's growing at 70%. I'll pay a 30 PE for that, but to pay 30 PE for somebody who makes coffee, I don't know. Analysts kind of think this is slightly discounted, just a 3.6% discount. And that's kind of like my sentiment, which is, hey, this was kind of a bump in value just because they hired a CEO. And I'm like, okay, it exceeded my value. I'm done. I don't know how much I made, probably 30, 40% on it. And I'm out. Took the gain. A win is a win. And since then, I have not regretted selling this one. I have regretted selling some stocks, but not this one. This one was a winner. So this one here, Starbucks, not really exciting. What's it doing year to date? Year to date, it's up 10%. Not bad at all. It's doing quite well because it had such a rough, I guess in December, it was getting beat up. Since December 20th. It's been on the rise, but it pretty much made it back to where it had been before. And it's really been in the mid 90s for a while. And it sounds like, there's not any like incredible news that's being disclosed. And I know the Starbucks business, some of the undesirables is they have to hire so many people. I'm not against, businesses hiring people, but it's just a reality that when you hire a lot of people, you have a lot of headaches, and these folks want to join, form unions. Not against unions, but a business just has one more headache when you have a union involved that's trying to control the business. So you have a lot of things there that are going to be really big problems for a company like that, as opposed to like other businesses like Meta. They don't have any retail. They just keep growing, and everybody downloads their apps and starts using them. So Starbucks for now is a pass for me. I don't think I'm not very excited about the business. And Warren Buffett, he has his comments on, do you buy a good quality, desirable business, or are you buying into a good quality CEO? And he clearly says a CEO doesn't matter. If you have a great business, highly desirable business, that business is the value. You could put a great CEO in charge of a terrible business, and you're going to have a terrible business. And that CEO is going to try really hard, but they're just not going to change the fundamentals of that business. So they hired a good CEO. Is he going to create a positive impact? Probably. But I don't see Starbucks doubling in value over the next 5 years. I don't. I think it's a business with limited potential. And I think that they've gotten so big that it's going to be very hard to grow. So a lot of things I don't like about Starbucks. I made some money. I'm done. Move on to the next one. Move on to the next swing trade. And that is my comment on Starbucks. So AT&T had very good numbers. They reported really well, and they're having a very good, I think year to date, they're up 7%, but the last 2 days, just really nice rise. They went from $22.72 a share up to $24. So that's a really nice rise. And my hang up with AT&T is just their debt levels really high, $175 billion in market cap. And when you look at their debt level, they have debt of 140 billion. It's like, whoa, that's a lot of debt. So when you look at this number, you know, the stock investors, you know, they have to contend with 140 billion dollars of debt. They have to pay interest on 140 billion dollars of debt. It's just a really, really big debt level. Their forward P is 11, so I cannot ignore that debt. That's why I stay out of AT&T or Verizon. Is that debt level over the 1 year? This stock's doing 41%. Congratulations if you own it. Over the 5 years, it's not even mediocre. You'd have to be in the positive to be mediocre. This is terrible. 15% decline in value, decline in wealth, dead money, didn't do anything. So I think the best is behind AT&T. You know, this is a slow growth business, right? No growth business, excuse me. And maybe they're expanding their profits, but look at this, negative, 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 slightly positive, negative. So there's not a lot to like here. Not a lot to like at all. Really bad balance sheet, no growth. They are a commodity business. The only thing I could say good about AT&T is that I use AT&T fiber, and I'm very happy with my fiber service. Thanks a lot, AT&T, for the fiber service. It's super fast, and I like it. So that's my comment on AT&T. I stay away from it. I don't like it. I don't like the balance sheet, and would be curious to see what you guys think. Do you guys look at the balance sheet? Do you care about the balance sheet? Do you care that the company has $140 billion of debt? And if they get themselves in trouble, boy, that's going to be a really deep hole to get out of. Meta has been rocking and rolling 15% on top of 71%, on top of 213%, with a big pullback in 2022 that offered up the stock as low as like $85 a share. Man, this stock provides a great opportunity, great appreciation, $170 trillion market cap, and it keeps going up because these guys have revenue of $156 billion. When we look at their financials, just beautiful financials. Growth, 23%. Hey, Apple, try growing. Try growing like Meta. And when we look at free cash flow, look at this crazy number, 52 billion. Hey, Tesla, this is how cash flow is done. Okay, none of this $3.2 billion stuff. How about 52 billion? That's why these guys are worth how much they're worth. And they've grown this cash flow over time. Just beautiful growth of cash flow. That's why Meta is worth what they're worth. Margins, gross margins, 81%. Hey, Tesla, I'm knocking on your door again. What's this 16% stuff? How about you try, looking at Meta? 81%. Fabulous, man. Awesome gross margins. So that's why this is a super desirable business. Is super high gross margins, high cash flow. It's been growing. Just a really nice company. I thought I was like just imagining things when the stock was so oversold during this period of time. It was like crazy. This is my biggest position in Meta. And you look at the type of business they have, their product is the content that the users create. They have the WhatsApp product, which is used by billions of people on Earth. They have Instagram, which was just a genius acquisition. So they have so many things going for them. and that it's just a really valuable business. I still think the stock is discounted, but I'm not buying any more shares because I own too much of it, and I just don't want to own. I already own too much of it, but I'm not going to sell any shares. A part of the reason I own a greater value amount is because it's appreciated a lot. It's still discounted by 27% in my book, but I'm not selling any shares and I'm not buying any shares. I think the stock's doing great. I think they're going to keep doing great. And I will be cheering them on. Go Meta. Keep doing what you're doing. Their businesses are really, really well lined up. Their AI business, I think you're getting for free. And if their AI business works, they have more than 3 trillion people accessing a Meta application every month. That is a huge market that they can sell AI to. So when we look at AI from China, and of course, a lot of the users from Meta are outside the US. The US has a population of 350 million people, right? Or something like that. Well, there's like over 3 or 4 billion people on Meta apps. A lot of the people are around the world. So although Meta, let's say the Chinese AI app is not allowed in the US, okay, that's fine. Meta can offer it in Latin America, Africa, Middle East, Asia, and they'll make money on it. They'll, they'll totally be able to capitalize on it because they have a global business. So Meta is in a really good spot for 2025. Needless to say, they're a very valuable business and I think worth it because they continue to grow their revenue. Go Meta. All right. So we talked Meta. Let's catch up on these comments. Michael Anthony, you want to talk pizza, man? You're going to get me hungry. I am going to get hungry. Every time I talk about a food stock, and I am streaming ahead of dinner for me, by the way. Down 10%, up a little bit in the after hours. They announced yesterday. So they announced yesterday. What's their year-to-date number? They're down 4%. I'm not excited about, restaurants. I don't like restaurants. This is a very small cap, 1.29 billion. Their PE looks fairly low. Nice dividend. The 1 year down 48%, 5 year down 39%. Whew, brutal. All right. Financials. So revenue is growing slightly. Looking at the quarterly, the quarter is even worse than the annual rate. All right. And free cash flow looks decent. Yep. This business, I mean, if you believe Papa John's is going to grow and you like restaurants and you like that dividend, I can't argue with an investor buying this. I'm not going to buy it. It's a restaurant. I just don't think this is going to be a long-term appreciating stock. But that's where it's at. It's kind of a boring stock. And man, we're having a year where it's fireworks. Man, we had yesterday. Holy smokes. Yesterday was the most interesting day we've had in a year, 2 years. And I think we're going to have more interesting days like that, where you just see the market, just ride off a cliff, especially some sectors. I think we're going to have more of that. Papa John's, I mean, I'd rather own a healthcare company. I'd rather own a financial services company, an industrials company. Pizza, a lot of competition. How many competitors they have? They have mom and pops they got to compete with. I mean, it's just competition is too much. So I'm a pass on Papa John's. I do like their pizza. Their pizza is good pizza. Now, I'm probably going to stir up an argument here, but I've had New York style pizza. I've had it in New York. Delicious. I had the opportunity to go to New Haven, Connecticut, and they believe they'd make very good pizza. I agree. That's my favorite pizza in the country now is New Haven, Connecticut. They had a community of Italians move there a long time ago, and they use the coal-fired ovens. And holy smokes, man. They make this super thin crust, and they fire these ovens at like 600 degrees or some crazy number. So they put the pizzas in there very quickly. It's kind of like a flash cook. They come out and the toppings are just ridiculously delicious. So New Haven, Connecticut is my number one spot for pizza. Very hard to get to. I was there on business. And then number two is New York. New York used to be number one, undefeated champion of the pizza world, in my opinion. I've had pizza in Rome and I've had pizza in other parts of Italy. And I think the Americans really are crazy about pizza. In Rome, I had other food that was just fantastic, man. Their pasta, their paninis in Florence. Oh, those things. I couldn't believe I was eating food. I thought it was so good. It was delicious. Just incredible food in Italy. All right. I'm getting off topic here. Talking stocks. This isn't a cooking channel or a restaurant channel. All right, let's get back into it. Somebody wanted to talk about HPE, and I think I kind of telegraphed that I'm not going to get into a legacy hardware company. These guys are a hardware company. They manufactured servers for a long time. Over the 1 year, look at that. And this is the AI hype. Hey, congratulations if you bought the stock. I'm glad you did well. And even over the 5 year, it looks pretty decent, 47.8%. They pay a decent dividend. But I am afraid that these guys are an old school hardware company creating servers and stuff. And that day is behind us. Everything's about cloud now. Everything's about getting cloud infrastructure and not buying hardware anymore, not buying hardware from Hewlett Packard or Dell or any of the server companies. These guys have a low PE because the market just doesn't really care about them. Market cap 28 billion, but their revenue is higher at 30 billion. So that's the rub here. Their growth is going to be kind of like just slow growth. And over time, this would just be less relevant. So that's why I stay away from it. It has performed for some investors. Congratulations. I'm glad it worked for you, especially if you bought it at these low points. Holy smokes, you're doing quite well. But, I feel like I only had a limited amount of time on a weekly basis, monthly basis to invest in stocks. And I'd rather go find the next Robinhood, the next Meta, the next, super success from a stock perspective. And if I own an HPE where I am already convinced this business is going to be expiring soon, I'm wasting my precious time. I'm wasting my analysis time. I'm parking my capital in something I don't believe in. So that's why I don't invest in HPE. I stay away from it. So that's my comment there. All right. Arjun, I think it's the first time I've seen your comments. Very nice to see you. Thanks for coming in. What is your view? Live everyday channel. What is your view on close-end funds? I don't know what a close-end fund is. Let's start there. Maybe I know it as. Is it like an annuity? A closed-end fund is a professionally managed investment company that fixes a number of shares to raise capital. The fund then invests the capital in securities like stocks and bonds. Okay. I've never seen this. I mean, I've seen SPACs and stuff. I've never invested in this. I wouldn't really be interested in that. I invest, in companies that I believe in. I have a lot of time doing it, so I feel like I have a very, very good rate of return. I wouldn't be interested in that. So that's the answer to your question. Michael Anthony. And they are getting lots of upgrades, which Goldman Sachs said a top pick for 2025 with a price target of $40. We still talking pizza? Are we still talking about Hewlett Packard? Either one. Some of these analysts, right? I mean, I hear some of these price targets and stuff and whatever. I don't take them for gospel. I do my own analysis. And I'll give you my own opinion, man. And FYI, I've been wrong. I've been wrong on some stocks. Palantir, totally wrong. Okay. And the stocks flourished. I still think it's overpriced. CrowdStrike, I was right for a temporary period of time. I shorted the stock. I made money. Now CrowdStrike's going through the roof again. So I respect that other analysts are going to be high on a stock. I'm not. Well, I'm going to kind of stick to my guns because it's based on fundamentals. And at least I could say, look, if I put those fundamentals through the same process as the other stocks, some stocks are going to just rise up to the top and some are going to drop down to the bottom. And I also need to understand the the big picture. And when it comes to like Hewlett Packard, I have been in technology for a long time, so I know who Hewlett Packard is. I know that they have a legacy in the Silicon Valley, but I know what their product is, and I know what's going on in the industry, which is everything's moving to the cloud. If you're an old school server company, even if you're premium servers, Hewlett Packard doesn't create any GPUs. All the craze now is GPUs. So these guys are not anywhere near where it's red hot. So anyway, moving on. So Carlos, so I think I shared with you Meta, I think is discounted by like 27%. And those are stocks that are really hard to buy because they just keep going up. And it's hard to find Meta or even Google. Like I think Microsoft's a good example. I think it's slightly discounted, and I'm buying as fast as I can because there's only one Microsoft, there's only one Meta, there's only one Google, there's only one, and I want to be on in those companies. I want to be a part owner. So that's how I go about it. I don't know how you would go about it, but that's how I do. So Michael Anthony, Meta should start dipping in at this price range. Okay. Live Everyday Channel. What do you think about AES utility company? AES. So AES with its subs is a diversified power generation utility company. So I don't like utilities, and I'll show you why. This stock is down 35% over the 5 years, down 45%. It pays a nice dividend. This is what lures investors into a utility. But if you look at the industry as a whole over the 5 year, it always severely underperforms. And the reason for it is, let's take a look at their cash flow, and I'll show you what the big problem with utilities is. So free cash flow is cash from operations minus capital expense. So they do cash from operations at 2.3 billion, but CapEx is 8 billion. And that's for the trailing 12 months. In the full year 2023, 7.7 billion, 4.5 billion. That's more than their cash from operations. Okay. And so, which means it's negative cash. Another way of thinking about it is, think of that pizza shop again. And a pizza shop buys ovens, I don't know, every 10 years, every 20 years, right? And it uses those ovens and then replaces them every 20 years. So they can depreciate it a little bit every year. So their capital expense isn't very high. They have the establishment, they have the ovens, they have the equipment, they just make pizzas and they can generate some free cash. But just imagine if the pizza business was like, oh no, you got to replace the ovens every year. Wow, that's a big expense. And that's a utility business. It's literally, they have to rebuild the business every stinking year, and they don't generate more cash than they have to spend in capital expense. So that's just a very undesirable business. And if you look at the industry, you'll see that the performance of the industry is very poor. But they lure investors in, and they're not doing anything bad, by the way. We all get to invest with our eyes open. We get to invest in the industries that we want to. So let me not kind of characterize it as these guys are bad. The dividend looks attractive is how I should phrase it, at 6%. Got it. But what does not look at, it looks horrible when you look at the performance of the stock. If I'm going to lose 45% to collect a 6% dividend, no, thank you. I know how to lose money and have fun different ways. I'd rather go on vacation, have a good time, eat at nice restaurants, have fun with my wife. Oh man, it was great. We spent a little bit of money, but we had a good time. I wouldn't want to buy a stock like this. I would have a terrible time and I would lose money. No, thank you. So all kidding aside, I do not buy utilities. That's I just explained why. All right. So Live Everyday Channel, Close End Fund like BST, has all the tech names. See, the thing that I dislike about these types of investments is you're buying, you're giving your capital to somebody else to invest it. Now, if you're a new investor and you're like, I really want to be invested, but I'm not sure I know what to buy and what to hold and all that stuff. Hey, you know what? That's cool. If you want to buy ETFs and try to learn every month, every year, try to get better. That way, at some point, you feel really confident, really capable in making really good investments. Well, that's one scenario. And there's young investors that are part of this community. And I have nothing against ETFs, but when you turn over your money to this type of investment, this isn't something I would do. These guys are delivering a dividend. Got it. The stock, the stock has appreciated. So not a bad rate of return, by the way. 5% appreciation plus 8%, 13%. That looks good. Just the type of person I am and the investor I am. And we should all like invest based on who we are, right? If you're hey, I just want to buy ETFs and be a passive investor, great. I wish you the very best of success. If you want to be a very active investor like myself, great. I wish you the best of success. I'm more of an active investor. I want to know how that stock performed. I want to learn something from it. I want to be better next month. I want to be better next year. And I can only accomplish that by being in the driver's seat and making these decisions. And I do own some ETFs. I do own bonds and so forth. I own Bitcoin, which I'm not in the driver's seat on Bitcoin. I'm just a hodler. So this one here, I mean, it's not an idea I can argue with, but not knowing much about you, if you want to wake up 10 years from now, much wealthier and more capable of making more money, in my opinion, you have to learn. You have to get better. You have to exercise the knowledge that you're attaining. And in my opinion, by investing in stocks, by seeing trends that, hey, what sector provides the best stock opportunities, and invest in those, hold them for a duration, 2, 5 years, 7 years. And then you see some really good winners. You double your money. You double your money in 2 years. You double your money in 1 year. You double your money in 3 years. And when you get good at that, then you start making really, really good appreciation. You start doubling your overall wealth in less than 5 years, which is exciting. So, long answer, but I think it's an important conversation to have. I think we've got 15 strong on the live stream. There's probably a variety of ages and styles and so forth. Always invest in things that you understand. If you don't understand it, I encourage you not to invest in it, because whatever happens, if you don't understand it, you're not going to learn anything, and it's probably going to run you over. And if you're lucky and it makes a lot of money, congratulations. But again, you didn't learn anything. How are you going to go find the next thing? It's pretty much kind of trying to buy a lottery ticket and hoping that it is a good lottery ticket, which is not what I do. I don't play lotteries. I don't even gamble a whole lot. I don't really gamble at all, because when I get to weekends, right, being a stock investor is so stimulating. It's so involved. Playing craps is like, that's nowhere near as fun as shorting Nvidia, which I'm doing. I mean, that's a bet. It's an educated bet. And right now my position's in the positive. So, call me crazy, but I'm making a little money on that position. As well as, some of these smaller stocks. I mean, I invested in this little company that's a new investment. And this came out of a live stream / we have a community conference call where we talk with just the paid members. And this stock came up, and it's a good one. I think very highly of this company. I started buying into them. But when you look at this small business, it's a $10.66 billion company. I understood them well. They've had a rough go at it because AI is supposed to completely replace them. I don't agree. I think these guys are actually going to be a beneficiary of the AI paradigm, and they keep growing their revenue. I mean, look at this growth, 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 growth. Okay, If these guys are dying, holy smokes, they're living really well in their old age. Just kind of all kidding aside, these guys have grown 1.3 billion up to 2.6 billion. That's really good. You look at their free cash flow, looks great. Look at their gross margins, look great. So the story behind this stock is nuts. It's not, in my opinion, I disagree with it, and I'm buying. Well, that's really fun. That's really fun to say, hey, I'm on the other side on this stock. I see good fundamentals. I have a good valuation. I'm a buyer and I'm buying. And so far, I think I'm close to even. It's also offered up really good places to buy the stock. And I think this one here, I'm not going to be surprised if it doubles on me in value very quickly, because I think the market's going to wake up to this stock. And of course, I could be wrong, but I could be right. And if I'm right, I think this one's going to really work. Forward P of 13.77%. I showed you the growth. I showed you their margins. I showed you their free cash flow. It's like, why is this stock underpriced? Analysts agree with me. I agree with them. We agree with one another. 52% discount based on analysts. And quite a bit of analysts, if I recall, look at this stock, 15 of them. So I'm not the only one saying, wow, the fundamentals look really good. So the whole story has been what's driving down the stock price. And I think the story is not valid. So that's a really neat little stock that came up out of the collaboration of this community. Good stuff. Speaking of software, let's go to DocuSign. I love this stock. You know why? Because they made a lot of money for me. It's I'm a pretty simple-minded guy. Up 56%. Stocks really offered up nice acquisition prices. This stock was left for dead because it went up too high during the COVID years. I agree it went up too high, but it just fell too far down. And it's really gone up over the last year. And year to date, it's up 8.6%. It went up nicely today because DocuSign is going to be able to use AI to, they have the best solution within the digital capture space. And they can probably use AI to run their business more efficiently, effectively, probably offer up some more services to their customers. They do document management as well, and they do it very well. They can continue to grow their business. Green on the screen, revenue is good. Margins are ridiculous, 80% margins. Beautiful. Great free cash flow. It's been growing. I like growing cash flow. I like when a business keeps growing their cash flow. They keep loading up the balance sheet with cash. Yeah, it's a good thing. And these guys can buy back shares. They have a good balance sheet. And these guys are an acquisition target, $20 billion. So just imagine a big giant company saying, DocuSign's a cool little business, makes a lot of money. Let's offer $40 billion for the company. And that's probably a total make-believe number. They probably offer like 30, 35 billion. And me as a stockholder, I'd be like, great. You want to pay me a 50% premium on my stock? I'll take it. I will take it. These small caps, we haven't had a lot of acquisitions for the last 4 years because the outgoing president and his staff were like anti-big business. And, I get that there's some folks that don't want large, massive businesses. Got it. But sometimes they just get in the way of the free enterprise capitalism in the United States that has built a lot of wealth. And yours truly has benefited greatly from it. So I'm a big believer because it's really created a lot of value for me and my family. And I appreciate it. So these guys here are totally acquisition target. I believe that. And so is Zoom. Let's take a look at Zoom. So I think DocuSign, before I move on, let me show you my valuation on DocuSign. So DocuSign is sold at a premium of 7%, and I'm still holding the stock. This one, I do not want to sell it because I'm sitting on a really big gain, but man, I would just I would be so upset if they get acquired. And I sold the stock and a month later they get acquired. I'll be like, oh, I knew that was going to happen. Or they just keep going up in value because they're fundamentals keep improving. They keep getting bigger, making more money. So I'm sticking to DocuSign. I'm not selling it anytime soon. I think it's a fair price at a premium 7%. They have proven that they're more valuable than their previous stock price. Their fundamentals look great. Their balance sheet's great. I am hanging on to DocuSign. Speaking of hanging on, Zoom, very similar situation. The software businesses were not getting the love from the market. The market was in love with data center semiconductor companies. They couldn't get enough semiconductor companies. Oh, Broadcom, Nvidia, Super Microcomputer. Talk about a really shaky stock. They just couldn't get enough of those stocks. And they forgot about Zoom and DocuSign and all these really quality businesses. These guys are continue to grow their revenue. They are a pretty good sized company already. They have ridiculous margins, 75.8%. They keep growing that cash. I showed you how Meta produces cash and where Meta's valuation is super high. Zoom growing that cash and disproportionately to their revenue. See how this cash is just taken off. And Zoom provides the best experience for video conferencing. And they are trying to expand into like communication services, like phone services and stuff. And that business is growing a little bit. But these guys are another acquisition target. And wouldn't be surprised if I wake up hearing that so-and-so business wants to acquire Zoom, because these guys can deliver profit, cash, margins, and they have an excellent balance sheet. Let's look at their balance sheet really quick, because I remember them having a crazy amount of cash, because they were trying to acquire another business that it didn't end up happening. But total cash, $7.7 billion. Okay. Very little debt, like 66 million. So I guess 7.6 billion, 7.6 billion of cash. And their market cap is 27 billion. So really, the market cap's 20 billion because there's $7 billion of cash on the balance sheet. If you bought the whole company for 27 billion, there'd be $7 billion in the vault. So you'd get $7 billion as a rebate. So those are the things that I look at within software and go, holy smokes, this is why this industry is really valuable. I mean, Microsoft's worth $3 trillion because they're a software company. And Zoom is really worth a lot because they're really nailing it. And investors just forgot about it. But today they remembered, hey, Zoom's really valuable. And they're probably going to use AI to really optimize their business, improve their operations, become even more profitable, maybe even add some services that increase that top line. They can probably raise their prices as well, by the way, because they are the most desirable video conferencing solution. I think they're better than Microsoft's Teams or anybody else's. They just have the best solution. There's a feature on it that I discovered today, which is 2 of the attendees on a meeting can share, which is kind of breaks my mind. How do they do that? So you're in one video conference and 2 participants can share their screen. That's cool. And that's Zoom. Nobody else can do that, which is cool. All right. So that's Zoom, man. The software space is clicking. I like what I'm seeing in software. So no more comments from the live stream, man. We're 22 strong. There's got to be some more comments. Come on. I'll even talk about another restaurant. What do you guys want to talk about? So we talked about HPE. Let's see, do I have any other? I did want to talk about, I guess let's talk about Goog. Goog is just hanging in there. It's a good stock, man. 1 year performance, 28%, 5 year, 174%. This is Google, 2.4 trillion in value. The PE, look at that, 22.87. Very reasonable. Strong buy, 7% discount. Looks good. Michael, you want me to talk about pizza again? Man, dude, come on. I'll talk about Domino's. That's what I'll do. Give me a second. All right. So Alphabet, big, massive revenue company, up 14% on revenue. Apple, I'm looking at you. Why can't you grow like this? These guys are big too. They grow 14%. What the heck's wrong with Apple? Free cash flow, beautiful. Look at these huge, massive numbers. That's what I want to see. And their margins, very good. They have a cloud business. And what I'm excited about when it comes to Google Alphabet is that they have the Waymo business. That's true robo taxi. It's working. They have it operating in multiple cities, and it's working. And they have their AI business. They are a leader in AI. They've been investing in it for a long time. So these guys over the next 5 years, just more value. They have awesome moats. They can keep their competitors away. Their search business is solid, just a very good growth engine combined with profit and free cash flow. Their YouTube business, you're watching me on YouTube. Creators create the content. It's the largest streaming platform in anywhere on earth. This is it. They're better than, or they have more users, more streaming than Netflix. I watch sports on YouTube because I'm so busy. I can't sit through a ball game for 3 hours, but I can go to the highlights and in 15 minutes know exactly what happened. That's on YouTube. You don't need Sports Center anymore. You can search, you can go international football, baseball, basketball, you name it. Every sport is covered. Such a good time to be a media consumer. So this business, I mean, I don't think a lot of people would argue with me. Google is one of the most valuable businesses, great moats. Some people would argue that, hey, maybe it's not going to perform like the rest. Maybe, but I'm good. I'm good. You do this, I'm good. You do that, I'm very good. Thank you very much. Double my money in less than 5 years. You're getting the job done. So Google, I think, is going to continue to get the job done. I'm happy with the stock. My value on Goog, I think it's discounted by 9%. Very rational. Am I buying more shares? I own a lot of Goog. So I'm very careful not to buy more because I own too much of it. If it dropped like 10%, I'd buy it because I don't know. I don't have as much in Goog. And actually, I've invested more in Goog than Meta. But Meta has appreciated so darn much that it's just, become a greater asset on my portfolio than Goog. That would be the situation. If they sold off, I'd probably buy some shares. But for now, I'm holding off because I own too many shares. This is similar. If using an example, Microsoft, similar discount, I'm buying as fast as I can because I don't own a lot of it. Microsoft is a very desirable business. So those are my comments on Goog. Amazon, Carlos. Wait. So I think Michael Anthony was joking about pizza. So I'm going to move on to Amazon. So Amazon hit a 52-week high, one of the least affected by the semiconductor crash. So Amazon's a super valuable business. And, the market from time to time does something surprising, and it's a nice opportunity. And Amazon, it sold it off in 2024. And it provided a great opportunity by Amazon. Look at that beautiful dip. Bam. Buy Amazon. And look at that upward trend. Beautiful. So when this happened, I bought as fast as I could. Covered it all on my channel. Covered it on live streams. Covered it on videos. I couldn't buy it fast enough. And I'm glad I did. It's up 49% with this big dip in the middle of the year. 5-year, 160%. This is going to be a solid stock. They have a strong business. E-commerce, number one. Cloud, number one. They have the media business with their streaming service, solid. They're now selling ads on their Amazon Prime Video. That's going really well. They even have a robo-taxi business in Zoox, and it's going operational. I think it went operational here at the beginning of 2025 in Las Vegas. So they have that business. I mean, Amazon is They have so many different businesses, and what is really impressive is a lot of those businesses are run really well, and they're competitive in each kind of field they're in. The one business I don't like is their grocery business. Whole Foods and Amazon has this other grocery chain. Now I own Kroger, so I'm not against grocery, but it's like, why is Amazon in grocery? It's like you're in this cloud business, which is phenomenal. You're in e-commerce, which is phenomenal. But then you got a grocery chain that's not just, it just doesn't fit kind of like the whole technology kind of space. But for all I know, they're going to turn that into a huge moneymaker, and I'll be glad because I own their shares. So Amazon's doing well. They too, they were accused of not making enough money. Look at this growth, just beautiful growth and a massive revenue number. And a while back, they were like, "Hey guys, you don't make enough money. You're kind of losing cash." And so the new CEO said, "All right, you guys want to see me make some money? I'll make some freaking money. Look at this cash just exploded." It's like, "All right, you want me to show you the kind of cash you can produce? 43 billion. Get your head around that." And then they expanded margins. Again, they have this massive number on revenue. And when you expand your margins by 6 points, actually 9 points over 4 years, 5 years on a $600 billion revenue rate, that's like $72 billion of margin. Okay. That's impressive. So this business is super strong. Awesome business. Analysts think I'm going to call it fairly priced, just a small discount. I'm going to agree with that. Actually, I might be pricing Amazon at a slight premium. Yep. 3%. It's just the stocks. Well, I'm looking at Palo Alto. -7%. So the stocks just really flourished. And I own a fair amount of Amazon. I'm not going to force it. I'm not going to buy shares unless they really sell off. And they didn't really sell off yesterday. I think they kind of held their own. It was down like 2 or 3% at one point. But I spent my time buying other stocks that I thought were a really nice buy. Like I bought all on Microsoft and I bought other stocks. This one I held off on because I own plenty of it. And I think it's fairly priced, actually priced at a little bit of a premium. So Amazon's just a stupendous company. Don't know that many people would argue with me. Now we're talking about Amazon. So let's talk about eBay. eBay has been a company that was one of the originals, right? Original company doing e-commerce, but the company has not been very exciting. Now, the last year has been super exciting, 57% rate of return. And even the 5-year looks pretty decent. Wow, look at that. Man, I guess I missed this one. Totally. Glad you brought it up. So eBay, super impressive for the 1 year. What's going on at eBay? Are people buying stuff on eBay? I haven't been on eBay in years, man. $32 billion in market cap, $10 billion in revenue. Their PE is really low at 13, even after going up 57% over the past year. They're paying a dividend now. Analysts think it is priced too high. It's 7% too high. But let's take a look. So they are growing a tiny bit. Okay. They're growing a tiny bit. Let's see if they're expanding margins and making more money. So, yeah, net income is, well, sort of. 2021 is a banner year, right? They just crushed it. Then they lost some money, and now I can't say that they're expanding net profit. Free cash flow looks okay. They haven't been growing free cash flow. It's actually going down. That's not the right trend. 72% margins because they don't really make anything. They just get a fee for listing something, and then when it sells, they get to make some money. So very good margins, but the growth isn't, floating my boat. It's very slow growth, not very good growth. Annually, I mean, it's not a big business, 10 billion, right? You should be able to grow. So that's why this one I missed it. I mean, but I don't think their fundamentals. 2 billion, yeah, it's really hard to. They're not growing. I'd probably get to like $20 billion of value, so that makes them, priced at a premium of 50% or so. So this one here is not a buy for me. It's a complete pass. Even when they were here, it was not exciting to me. It's like, I don't think they're going to be worth much more in 5 years. It is surprising that they've done this well over the 1 year, even over the 5 year, right? Once they had that, and this was an unexpected um, event of having COVID and everybody's at home buying stuff on the internet, going back to eBay because they have probably more used things, and even they have things that are more like unique creations that artists put out there. So I get that, but that's just a one-time deal. You're not going to get a pandemic every other year. And once that was gone, it's like, well, this business has no catalyst to make it really exciting. Somehow they got a catalyst to make this stock move. Interesting. Maybe they're saying AI is going to help them, sell more stuff, maybe, but you got to start showing me the facts. You got to start showing me these metrics grow. Start growing at 10%, then I'll pay attention. And that's my opinion on eBay. I'm staying away from it. Futures down just a little, which Powell speaks tomorrow. Yeah, I don't think Powell is a big factor going into tomorrow because I think there's big forces that are circulating, like DeepSeek and investors being scared of these really expensive valuations. I agree that, well, I would say that Powell could cause the market to sell off, but I don't think he could say anything that's going to cause the market to rally. And I mean, I think the market's pretty touchy right now. If he were to say, yeah, I don't expect we're going to do any rate cuts in 2025, the market's going to sell off. If he says, oh, we're going to have a couple of rate cuts, the market might be like, all right, whatever. It's not going to do much. We'll see what he says. I'm not a big Fed. Like, you got to watch the Fed. You got to understand the Fed. But I think there's too much obsession on the Fed and interest rates. I think if you buy quality businesses, they're going to do well. Whether the interest rate is 2%, 5%, it's going to do well. Okay. Meta was doing great when it was 0% interest rates, and they're doing great today at 5%. I'll focus on finding the right businesses to invest in, and I'll let the Fed try to figure out how to run the economy. All right. So Trump wanting to fire Powell. Yeah, he'll probably, if Powell says something that scares the market, I think Trump will be all over him through the media, just bad mouthing him and saying the guy's an idiot, stuff like that. But I'll see what happens. All right, guys. So it's been a really good stream. We went about 2 hours. We're 17 strong. Really appreciate everybody attending, bringing all the comments. Really appreciate it, guys. And let me shut this down and go eat some dinner. Everybody, good luck this week. Tomorrow's going to be really interesting. It looks like the pre-market really isn't telling us much. There's nothing like, there's no like DeepSeek, another DeepSeek story out there. So it's pretty flat. And it's might be kind of a boring day. And then when the earnings come in after hours, then the fireworks will go off. And the fireworks will stay on during Thursday's session. That's my best prediction of how things are going to play out. We'll see. All right, everybody. I really appreciate you coming to my live stream and hanging out. Hopefully you found my comments interesting. And we covered a lot of ground today, guys. Man, I'm looking at the list here. I think we covered a total of 14 stocks. Excellent work, everybody. Appreciate you bringing up all those stocks. Let's keep it rolling. It's going to be more interesting tomorrow. I'll be back same time, 5 p.m. Pacific, 8 p.m. Eastern. And we'll go over the earnings that come out tomorrow. And there'll probably be some other stocks that catch your attention. And then we'll go over them. So Everybody, thanks for tuning in. Good luck with your investments, and I will talk with you soon.